Hello, I'm John Swift, the Chief Investment Officer and co-founder of Benchmark Investment Advisors, and I welcome you to the first quarter of 2022 Market Outlook. In summary, a couple of points. In 2022, we believe that interest rates are most likely to rise because of the Federal Reserve policy to combat currently high inflation. But they will attempt not to raise them too much or too quickly, which would hurt continued progress towards achieving maximum employment. Now, this higher wire act of balancing between inflation and jobs would make the Wallenda family of acrobats jealous, and history suggests that the unwinding of monetary stimulus will have periods of high anxiety as investors follow every slip and trip that Federal Reserve Chairman Jerome Powell makes on this difficult transition towards a tighter monetary policy. Now, higher interest rates are usually negative for asset prices due to the lower present value of the future cash flows. Still, economic conditions look good to strong in 2022, and the market may take these higher interest rates in stride considering the prevailing economic fundamentals. But investors should temper their expectation given the incredible results over the past 2 years during these unprecedented times, 2, the prospect of higher interest rates, and 3, the relatively high valuations going into 2022. So to wrap up 2021, it was really a year that was met with multiple expansion. The ultra-accommodative monetary policy combined with an aggressive fiscal stimulus push ushered in a period of price-earnings multiple expansion. Suddenly, the earnings outlook was bright again, and the market participants were front-running the expected earnings growth. On March 23rd of 2020, the forward 12-month price-earnings multiple was 13.4. It would reach 24.1 by September 2nd before entering a lower range. And according to Yardeni Research, it currently sits at 21.5, which is a 28% premium to its 10-year average. The S&P 500 isn't as richly valued as it once was, yet it is closing out 2021 at a rich valuation before the Federal Reserve has raised the target range for its Fed funds rate even once. However, what also jumps out is that multiple expansion has been harder to come by in recent months. Presumably, there is an understanding amongst investors that earnings growth will be slowing in coming quarters as comparisons get more difficult, and that a monetary policy shift to a less dovish position will be part of that equation. Now, that doesn't mean that stocks can't go up in price. Instead, it means that they will be more challenged to increase as investors become more discerning about how willing they are to pay for every new dollar of earnings in a changing interest rate environment. Hence, the S&P 500 in 2022, absent a shock on interest rates, COVID, or geopolitical fronts, might have to settle for increasing in line with earnings growth as the bull case. Now, that wouldn't be a terrible outcome. According to FactSet, calendar 2022 earnings growth is forecasted to be 9%. And the St. Louis Federal Reserve Economic Data, FRED for short, indicates a 4% real growth rate of domestic products. So the price return for the S&P 500 would be closer to its long-term average. Earnings estimates will be a moving target, and one can expect interest rates move to contribute to that action. Now next, monetary tightening. Monetary tightening usually is not good for the stock market. The Federal Reserve has communicated its expectations about tightening, but these are subject to change based on incoming data. Investors need to consider the many other influences on stock prices, ranging from the Omicron variant of COVID-19, domestic spending, and the global political and economic crisis. China has not lived up to its promises provided in the Phase 1 component of our trade pact with them, and Putin's military buildup at the Ukrainian border provide 2 tough tests for the Biden administration heading into this year. However, with respect to the market outlook, the primary concern is the unwinding of the monetary stimulus of the past 2 years, which will undoubtedly create financial disruption along the way and send nervous investors running for the exits at the first sign of trouble. Inflation, a hidden tax on the economy. Inflation has been surging not only because of the Fed's easy money policy and unprecedented fiscal stimulus coming from Congress, but also from massive increases in consumer demand that stretched and in some cases broke global supply chains. In addition, a tight labor market punctuated by the Great Resignation has also continued to add to inflationary pressures. Inflation will diminish in 2022 as supply lines regain their traction, but higher wage rates that will get people back to work will work against this trend towards lower inflation. Now, higher inflation forces companies to pay higher taxes as they earn a markup on the difference between buying and selling inflated goods, assuming they maintain stable profit margins. Additionally, companies are forced to allocate more working capital to inventories during inflationary periods. And finally, consumers and businesses will devote more resources towards watching prices when buying and selling. As a result, inflation acts like a tax levied across the entire economy, and it adds up fast. Higher interest rates negatively impact both stock and bond market prices and real estate values. By themselves, higher interest rates are negative for stock prices for two reasons. First, higher interest rates mean lower present value of future cash flows. And in addition to lower present values, higher interest rates will slow down economic growth, possibly even to the point of triggering a recession. This is because they first diminish interest-sensitive spending, such as new home construction, automobile purchases, and business capital spending. People will then earn lower incomes in these sectors, reducing consumer spending. Accordingly, not only will incomes be lower, but the remaining earnings will be discounted further due to the higher interest rates. But sometimes the stock market rises when interest rates rise. In general, interest rates rise when the economy is strong. When the economy grows fast, both businesses and consumers borrow more and save less, pushing interest rates up. As a result, we cannot say that higher interest rates are alarming because they are sometimes the result of a strong economy. Similar low interest rates occur when the economy is weak, due to less borrowing and higher savings. However, there is more to stock market prices than interest rates. Investor attitudes play a crucial role in the short run, but they are hard to predict. Sticking with fundamental factors, the pace of the COVID pandemic will impact stock prices as it will be a significant factor in the overall economy. We have already seen increased travel restrictions, and state and local governments will be walking their own tightrope between protecting citizens while not hurting their local economies. The negative effect of Fed tightening on stock prices may not push the stock market down if the economy grows. The significant rapid gains of recent years can only cool off into smaller gains. Bond yields are still historically low, so few will shift from stocks to fixed income for current yield. However, bonds have much less downside risk, and the argument for holding some, even when prevailing bond yields do not provide a positive real yield. Portfolio strategy. In 2022, there will be an increased appreciation for profits, positive free cash flow, dividends, and mostly the ability to pass along higher prices to end consumers, which often gets overlooked in an environment when there is no fear of a rate hike from the Federal Reserve, let alone multiple rate hikes. The bull market party doesn't have to end just because the Federal Reserve is signaling that the policy will be less dovish. To be sure, the policy isn't going to be hawkish. Even when the Federal Reserve announced that it will be quickening the pace of tapering, the Federal Reserve will still be buying billions of dollars of Treasury and agency mortgage-backed securities for several more months. Furthermore, moving the target range from 0 to 0.25% to 0.5 to 0.75%, which is currently forecast for this year, isn't exactly a death knell for the stock market. The party then can continue, but the music will be turned down in notch too, and the punch bowl will be a little less intoxicating. Perception matters too. Now, on March 23rd of 2020, the perception was that the Federal Reserve was all in, and the stock market had been running with the bulls ever since. The perception now is that the Federal Reserve will not be the gift horse it was in 2022, and that it was in 2020 and 2021. Instead, it looks poised to take back some more of its gifts, which means the froth in the stock market won't be the same, or shouldn't be the same. Price returns at the index level should moderate, the speculative energy should lose some spark, volatility should be higher, and the back and forth rotation between growth and value will persist. Importantly though, with the shift to a less dovish policy, party rules dictate that the penchant for buying unprofitable growth at any price should give way to buying profitable growth at a reasonable price. These conditions support our stocks that focus on having high levels of sustainable free cash flow returns relative to the underlying cost of capital of running these businesses. In 2022, we believe that the FANG-type stocks, Facebook, now Meta platforms, Amazon, Apple, Netflix, Nvidia, Google, and Microsoft will outperform. Healthcare should fare well, and stocks positioned to benefit from infrastructure spending should also outperform. Additionally, we are steering clear of stocks with high level of future earnings versus current earnings, known collectively as high duration stocks, that were the darling IPOs over the past several years, but are still ramping up their businesses with low current profitability. These types of low current earnings stocks are concentrated in hot sectors such as electric vehicles, cloud computing, and clean energy. We look forward to catching up with each of you, and we'll be reaching out to schedule a time to meet in person or by video link. If you would like to get something on the calendar in the interim, please send me a note with some dates and times. And also, if you know folks that we should be talking to, please let me know. And until then, take care.